Hey everyone! Today we're going deep into two important economic concepts, inflation and monetary policy, and how they shape everything from prices at the store to the interest you pay on loans and even your job prospects. What is inflation? Inflation is when the general price of goods and services rises over time, making your money worth less. It's measured by the Consumer Price Index, CPI, which tracks the cost of a basket of goods and services that households typically buy. There are two main types of inflation. Demand-pull inflation happens when there's too much demand in the economy, like during an economic boom. People spend more, demand exceeds supply, and prices rise. Cost-push inflation occurs when the cost of production rises, like when oil prices spike or wages increase. Businesses then pass those extra costs on to consumers by raising prices. Effects of inflation. Inflation has widespread effects. Businesses face menu costs, constantly having to update prices, while consumers deal with shoe leather costs, spending time finding the best deals. Some people benefit from inflation, like borrowers, whose loan repayments become cheaper in real terms. However, others, like savers and people on fixed incomes, lose out as their money's value decreases. Inflation can also trigger a wage price spiral, where workers demand higher wages to cope with rising prices, but those higher wages push prices up even further. It also makes goods more expensive globally, hurting exports and jobs. Monetary policy. To control inflation, the South African Reserve Bank, SARB, uses monetary policy, which involves adjusting interest rates. Lower rates encourage borrowing and spending, but can lead to higher inflation. Higher rates do the opposite. They make borrowing more expensive and saving more attractive, slowing down inflation. The real rate of interest is what's left after subtracting inflation from the nominal interest rate. For example, if inflation is higher than interest rates, borrowing becomes cheaper, encouraging more spending. How the SARB controls inflation. The SARB's goal is to keep inflation within a target range of 3% to 6%. They look at factors like economic growth, wage increases, and exchange rates when deciding on interest rates. When the SARB raises its base interest rate, banks follow by raising the rates on loans and savings, which cools down spending and investment. When rates are lowered, the opposite happens. Borrowing and spending increase, stimulating demand. Impact of interest rate changes. Interest rates affect many areas of the economy. Housing market. Higher rates make mortgages more expensive, reducing disposable income for homeowners. Consumer loans. When borrowing costs rise, people take out fewer loans, which lowers demand for big purchases. Business investment. Higher rates discourage companies from borrowing to invest in new projects, slowing economic growth. Lastly, there's stagflation, a tricky situation where high inflation is paired with slow economic growth and high unemployment. This was a big problem in the 1970s, and it's especially hard to manage because raising interest rates to control inflation can slow an already weak economy even further. That's inflation and monetary policy in a nutshell. Understanding these forces helps explain the ups and downs of the economy and how they affect everything from prices to jobs. Thanks for watching.